Thank you everybody for joining here today. We are super excited to have you here with our CEO B2B Marketplace panel on distributor financing, the hottest feature of B2B marketplaces. Let me share our agenda for today. So first we're going to start, we'll give you a bit of background when we talk about this B2B payments and financing. What is it? What do we mean? Why is this important? And you're going to hear straight from the source. We've got two great speakers with us here today, Shep Hickey, founder and CEO of Bryzos, and Scott Barrows, co-founder and CEO of Bluepallet. Both of these guys have been big leaders in this B2B payments and B2B marketplace space for a long time now. Very excited and honored to have them here with us. And I think they're going to provide a great perspective on why this feature is so important, how they've seen it work for themselves, and what does it actually look like. So I think it's going to be a lot of insight here today. Then we'll have a panel discussion with myself, Scott, and Shep, and then we'll have some time at the end for audience Q&A. So to get started here, what are we talking about? Why is this happening now? Why do we call this the hottest feature in B2B e-commerce? Well, I think the short version is B2B financing has been around for a long time. This has been a key part of the distributor value prop for many, many years, providing financing, helping their customers manage cash flow. The challenge is a lot of this process has been analog. It hasn't been a digital process. Now that is changing and changing very quickly. We see 130 trillion in total B2B payments for B2B trade that is looking to come online. That's been accelerated by COVID, but still today, 60% of that volume is still happening in many cases with paper check. But we've seen a big shift, particularly in the last 24 months, where the rise of B2B marketplace is really leading the pack, integrating this feature. And we've got two prime examples with us for the panel today. Have been driving this growth, and you're seeing digital payment methods like ACH grow very quickly. And they're solving one of the biggest pain points for small and mid-sized businesses that are the buyers and sellers on these marketplaces, which is ultimately cash flow and how do you get net terms in a way that doesn't hurt, which we'll talk about here in a minute. And we've seen adoption really take off in the last, as I said, the last 12 months. We have two members here that have already implemented this feature, so you're going to learn from their experience of having done it. But from our knowledge of the kind of top 50 B2B marketplace ranking that we do, about more than 50% of the top marketplaces we expect are going to have this feature by the end of this year, as part of their kind of core value prop. What is the unlock here, and why does this work? As I said a minute ago, the really big thing is that B2B commerce doesn't have to hurt. The historical process here has been reams of paperwork, weeks to get approval. You've got to send a bunch of forms. It's been very manual. You're buried under a mountain of paperwork on the seller side and the distributor side, and on the buyer side, it's a frustrating process. It's not transparent. You have to wait. And really what this has been replaced with is a kind of end-to-end, fully digital process where in many cases you can get instant or close to instant approval with only a handful of pieces of information. And that's really a big piece of what's made this compelling, is it's instant. It's this kind of B2C-like experience. That might sound simple, but it's not. There's a lot going on behind the scenes to make this actually work and be successful. And the challenge is that you've actually had to wrap a lot of sort of services that aren't new, but that haven't played well nice in a digital environment. And they are for the first time to actually make this an invaluable service layer to make B2B commerce seamless. Now, what are some of these key features? What does that mean? The key parts of this are, one, the kind of instant credit check. So we have that ability to get and enroll in net terms quickly. And then from there, the ability to actually get extended and pay back in net terms. This is kind of the buy now, pay later equivalent for B2B. Of course, it has been in B2B a lot longer than buy now, pay later has been around. So it was buy now, pay later before buy now, pay later even existed. But now it can happen in the same kind of B2C manner where it's online, digital, and seamless. The other important piece of this, and one that is a lot of complexity sits behind this one item, payments orchestration, the ability to pay how you want. You want to pay by check, credit card, ACH, wire, other forms of digital payment, in some cases, things like virtual card. There's a lot that goes on behind the scenes to make that happen and to kind of make that pay how you want magic work. Another important piece that is involved here then is particularly when you're talking about marketplaces or distributors selling, better cash flow. So the ability to extend net credit terms, but you have either the marketplace or some of these fintechs that sit in the middle that enable you to get paid, right away or within a couple days. And they couple all of this kind of end-to-end magic with back office automation. So they're handling the AR and AP processes and providing software and tools for buyers and sellers to manage this process digitally and to not have to, handle all in their legacy systems. Or if you've got some nice systems that you like, in many cases, they can also integrate into your ERP systems and make it pretty seamless. The end result is what we call in-checkout B2B payments and financing. It sits seamlessly in the kind of digital workflow for B2B eCommerce, B2B marketplaces, and it has been a huge growth accelerator for this sector and is going to continue to be in the years ahead. What are some of the key benefits we see here? Talked about some of these on the previous slide, but really it's about making it easy to get net terms, making it easy to pay how you want on the buyer side. And on the seller side, the improved cash flow is a huge selling point. Getting paid on time. We know the kind of dirty secret of B2B payments and financing is very few people actually pay on time. So kind of if you can take that headache away as a marketplace from your sellers, that's a big selling point. And then the ability to integrate into your native, ERP or other environments, and the ability to kind of do everything in one place. I mentioned a minute ago, a big part of this is payments orchestration. So the kind of front piece of this is enrolling in net terms. The back piece of this is great. You've extended somebody credit. Now you got to get them to pay, and you've got to make it easy to pay. And that's where kind of payments orchestration here comes in. And it's a lot that sits behind the scenes. There's some providers that do this, themselves. There's some marketplaces that have built this capability themselves and layer net terms on top, but it's not an easy thing to do. And you've got to enable a lot of different types of payment, and it's more complicated in B2B because B2B payments tend to be larger, and they also tend to involve more different types of payment like ACH. And you've also, in many of these industries, have to accommodate still things like wire and check as things continue to come online, and how do you integrate that into how you work today? So that's it for hearing from me. You're gonna hear now from our great panel. We're going to start with Shep Hickey, the CEO and founder of Bryzos. For some context, I've asked both our speakers to keep this high level, so we're not going to be talking about specific partners or solutions. But really about what's the value and what is it that really made them prioritize this as a feature. And I'll pause here and let Shep take it away.
Nick, thank you for having me today, and Scott, it's good to be with you. So Bryzos is really a market network, meaning we are a marketplace, but we have that's focused on the steel industry, but we have kind of a stack of SaaS solutions, meaning that when you look at a platform like Bryzos, you've really strung together solutions along the way to usher a buyer and seller from basically onboarding onto the platform all the way across to a seller being funded and the payment orchestration, making sure payments are coming in. So in the string of a platform of solutions, fintech is one of the many nodes that you see across the solution sort of stack. But in the simplest terms, Bryzos is an online steel marketplace that facilitates trade between buyers and sellers. So that's sort of the simple statement. But I really want to focus on the fintech piece. And in your introduction, I organized my thoughts before meeting today, and you said a couple of things that I kind of quickly want to comment on, which is one of the big differences that is I've had trouble articulating over the years, but I've sensed it, is that historically in buy now, pay later sort of scenarios, you have borrowers or technically, we'll go to technicality, but the person you're lending money to may need you. They need your money. They're trying to get something done. And the big difference is that they would come to you, like as a source of funding, they would come to you. And in this case of supply chains, you have like this monolith of like economic strength that doesn't necessarily need BNPL. They've been doing it for a long time. So what I've really noticed is that BNPL needs to sort of migrate to them. And when you're creating these early solutions in like 2017, the initial challenge was how do you, these are fantastic B2C companies, but B2C has a certain framework and B2B has a very different framework. And I think the real difference lies in the fact that industry is messy. It's not this clear cut and dry. And, to a certain extent, people like writing checks because they can sort of have this amorphous movement of money that allows slack in there. It's like a built-in period. So, but let me get to why our fintech solutions. So I probably first started wireframing Bryzos in real terms probably in 2013. And in that very first sort of list of things that would have to be done, I called it open terms, was there was going to have to be some sort of finance solution because credit lubricates supply chains. Unless you get down into sort of different parts of a supply chain, but the main sort of supply chain is really lubricated by credit. So I knew that from the jump. There was never an instance that didn't include some way for buyers to buy now and pay later. And so really the progression, let me back up one step, which is how it got into my line of thinking, which is it's never made sense to me, especially in distribution, that you would buy steel from a mill, pay that bill, and then effectively lend money to a buyer, right? So they can buy it from you. So you run the chance of buying something twice, perhaps. So it seemed never really made sense. So when I thought about Bryzos, I thought, how do we take sellers out of the banking business? That was like on my mind. And at that time, there weren't a lot of solutions, and there were a lot of phone calls, but really the first solution was very clunky, but it worked. And it got done what needed to be done, which was buyer could check out. At that time, it was net 90. And then sellers were guaranteed a payment, on day 30 or something like that. So since that time, we've come into COVID, which has been an interesting time for a number of reasons, but through that, and we just keep tightening, keep making it better. And I think part of that's because the BNPL solutions have sort of really begun to understand the dynamics of supply chains, meaning there's a rigidity. It's like an ERP system. You need to have enough rigidity for it to work, but enough flexibility that's usable, right? And I think that's sort of them going through their evolution. As far as how we integrate fintech, we built our own payment rails, right? So we own our checkout, we own all of the payment orchestration, so we manage all of that because I wanted to build things in a very modular way, because as these businesses evolve, and they're all really good, there's going to be a lot of sort of pivoting going on, right? They're going to find that this is their niche over here, this is their niche over here, and that's fantastic. But as a marketplace, you've got to say, well, if that BNPL pivots and does something that's better for themselves, which is great, I hope, good luck, but it can't take everything with them, right? You can't just be like, I'm out of here. And, now we've got to have our sellers re-signing up and our buyers re-signing up. So that's the reason we approached it the way we did, is just for a kind of user stability. And to date, I mean, the majority, over 50% majority is done through BNPL. It just works very well. It's come a long way. So that's sort of my high level overview of our trajectory, or how we're using BNPL.
Awesome. Thank you very much, Shep. And great perspective there. Again, Bryzos has been one of the leaders, as Shep shared there, that they've integrated this from the very early days into the kind of vision of Bryzos. We're going to hear from another leader in this space now, Scott Barrows, CEO of Bluepallet.
Thanks a lot, Nick. I appreciate it. It was great listening to Shep, and actually had an opportunity to speak with Shep yesterday. And we're in very similar positions, as I'm sure many of the people listening to this webinar are in as well, where we're trying to bring in some industries that have not gone through the full digitization of moving into e-commerce and platforms and networks and so forth. And so us as platform providers, the onus on us is to look at these opportunities on how we can bring more and more value to the customer, to the point where they see it and they say, this is worth it for me now to move my operations or these types of transactions online. And so, when people look at the opportunity to add B2B payments to their platform or to their offerings, I think it's important not to just look at it as if you're talking to a VC or an investor and say, hey, I've got an additional revenue stream that I can introduce here, and they get all excited. I'm trying to bring on and provide as much value as I can to this industry that I'm trying to have come do an immense amount of change to how they do traditional business. And so the B2B payment and being able to control the cart, as we use as a term, being able to move the money and add that to the equation is an extreme opportunity and responsibility, I believe, to any true B2B platform. So if you don't mind switching to the next one, Nick, real quick on Bluepallet. We are focused on the chemical industry. What we focused on initially is being able to provide end-to-end transactions, giving it a B2C-like feel, and making sure that we have vetted participants in a private network and marketplace instead of an open marketplace such as an Amazon. Our initial vision and goal for the platform when we first started building the marketplace component was taking what is traditionally in our industry a 5 to 7 day process to procure a new product and reduce that to 60 seconds or less. And having B2B payments in there was a critical component to being able to complete that goal. If you can go to the next one. I was really excited to hear Shep mention market network. We are a market network as well. I am a firm believer, as is the rest of our organization, that the market network platform structure is going to be the future over traditional two-sided marketplaces, and that it adds so much additional value to the participants. One of the key things in here that made B2B payments so important to our decision-making to add and to highlight is that, especially in an industry such as chemicals, it's extremely commoditized market, very low margins, especially on the commoditized products. And so companies that had failed in the last 20 years trying to create a B2B platform for the chemical industry came in with the traditional two-sided B2B marketplace or two-sided marketplace model, where they want to sit in the middle of every single transaction and charge X%, 4%, 6%, whatever. You can't do that when people are only making 1% to 2% on a lot of these transactions, and or when there's reoccurring transactions that's been established business for the last 10 years, and these are $1 million deals. No one's going to move that transaction online or onto your platform just because you made it slightly simpler and give you 4% when they're making 2% of an already established deal. So that's why in the market network structure that we wholly believe in, there is a marketplace component where people can go and broadcast inventory to partners or new buyers that they don't know and have relationships with, and they're fine with us making it a markup. But when it's their own network connections, we create a free trade zone where we're not taking a transaction fee. And because we are able to have the B2B payments in there, that adds value to them to be able to put in the terms, the net 30, the net 60, to be able to put in the, hey, great, I can already give this person, or they can go in there and get the in-cart financing and factoring. It gives us a chance to make a small transaction fee off that, even though it's considered a free trade zone. The onus is once again still on us, making sure that that that's a seamless experience, and B, that we're coming in with a competitive rate against something that they can do offline. But I think that anyone that's looking either at a traditional marketplace model, but for those that are starting to adopt and really go into this market network structure, and also are finding themselves in markets that have very small margins, this is very critical to be able to offer those services in the checkout, so that you can allow these participants to freely do these transactions with each other that you would probably never be able to coax onto the system, and still be able to capture a small piece of revenue, but also providing additional value back to your members and participants. You can go to the next one, Nick. And so a closer look, I wanted to share with you some individual examples of kind of how we've gone about this, either incorporating the in-cart financing or in-cart factoring into the checkout, also just the B2B payments in general, how we try to streamline that. And then the last part, I want to make sure to share with you kind of the ancillary values that you will also receive when you start providing this in your platform. So a real quick look at our checkout process here. As I mentioned, this is a B2C type feel that we've tried to create for what is a very complex industry with complex products, complex logistics, and complex needs for high value transactions and different transaction types that can't just be done with a Visa or MasterCard. So, being able to do ACH, being able to do escrow, being able to do wire, that's critical. Also, if you, no one's, our average transaction size on our platform is anywhere between $20,000 to $25,000. A company shouldn't want to be having to take a 3% hit on that with credit cards. So ACH is table stakes for making sure that that's in there for the transaction. We will be moving internationally here within the next couple of months. I'm sure a lot of people listening to this will want the same thing for their members and for their platform. So being able to offer those additional types of escrow and wire capabilities are going to be critical to be unlocking those new regions. As I mentioned, the in-cart financing and factoring is on both ends. And then also a thing that doesn't get brought up a lot is when you're able to control the cart and provide this value for your customers and your members, managing the domestic and international tax liabilities or the marketplace laws that are in place now, they are extremely complex and difficult to integrate into the checkout, and to be able to do these types of transactions. That onus shouldn't be put on the back of a $20 million a year distributor that's in Tulsa. There is opportunity for people listening to this that have B2B platforms and marketplaces to understand, if you come in and you provide the right product and the right service, you can be the one that helps them with that and give them a tool to be able to navigate and then get into this new digitized world. And then in our industry, and I'm sure with a lot of ones and also with chefs, the automated logistics and trucking is a key component as well. If you go to the next one. And then one other opportunity too is making sure that you have vetted participants in the system. So we use a technology that we built called TradePass, where it verifies over 2,000 different data points on the company. But if you can move to the next one, it also goes and verifies their bank account, does a credit check on them. So it allows them us to start offering terms for them, levels of credit, make sure that they have insurance, and then does some KYC and KYB checking as well. But being able to link with someone's bank account provides you value to providing a more secure network too, because that gives you one extra level of security, making sure that you are verifying who that company is. Secondary, it also removes friction in the transactions, where all of a sudden, as soon as that company's in, their bank account is linked, you have the ability for them to move money via ACH, wire, escrow, and so forth. Like that takes 5 to 7 days to get set up as well for a transaction. So you've all of a sudden eliminated that for them and reduced it to almost seconds. That's a lot of value that you can add for your members. Next slide. Here's just a quick look at our TradePass when someone signs up. This gives them a 24/7, 365 passport to go do business with all their trading partners along with their banking information tied to it. And then last slide. And then this just walks right through where you can pay with your linked bank account or initiate a bank transfer. And then we can go through these slides. Next one. So once again, you can link here with the other bank accounts, credit cards, if you wanted to use it for a smaller transaction. Next screen. And then also, as we've been talking earlier, setting the net 30, net 60, net 90, and click to the next screen on that. So that's just where a customer would select if they want to just pay right now with this preset net 30 by the seller, or they can go and start extending that if they need to for their own cash flow needs. Next slide. And then this is where they would select it. And then next slide. And then what bank account you want to use for. Next slide. And thank you. So hopefully I just provide a little bit of background on what we built for our checkout, for our B2B payments, and give you some ideas and concepts of value that you can provide for your customers through having that checkout capability, money movement capability, and some also the ancillary benefits that allows you to build a more secure network of participants.
Excellent. Thank you very much, Scott. And we're now going to move to the discussion part of the conversation. For the attendees, if you want to submit questions, we'll be doing audience Q&A at the end of the discussion section. So feel free to click the Q&A button. It should be across the bottom of the Zoom interface, and submit your questions, and we'll get to those in a few minutes. I think the first question, and I'll start with you, Shep. You were an early adopter in this. What was the biggest challenge in kind of implementing this payments and trade credit space for Bryzos?
I think the biggest challenge was kind of the discord between what B2C has developed as far as fast ways to underwrite and move money, and the industry's appetite for doing things like sign in and giving their online bank credentials for underwriting purposes, right? So you have all these great things that can instantly do things. So much like Scott was showing, we have the functionality of checkouts and so forth. I think he's right on point. But then I think there's also sort of the reality of where industry is. How ready and willing are they to, sign in with, hand over their business checking account login credentials, right? So that's one of because so many BNPL or fintechs, that's the linchpin to it, the ability to instantly do something. And so if you have these great solutions, but a population of prospective users that don't want to give that information, how do you move forward, right? And so that's one of the hardest parts of getting a solution that can really work. And that's part of the evolution is getting people comfortable. And you can't sit there and say to yourself, well, I know that person probably has Venmo on their phone in their pocket, so they probably already used, this software to link a bank account. You can't sit there and think about that stuff. You say, well, the reality is that they're not ready, willing, and able to use this process the way we've made it. So how do we dial it back? How do we manually cross this, create a bridge over this water? And so that's the piece that I think a lot of people are thinking about right now.
Excellent. Thank you, Shep. And Scott, same question. What was the biggest challenge that you've had in implementing this B2B payments and trade credit?
I would say it's identifying the right partners that give you the right services. To be honest, a couple examples is when we were looking to find someone for our ACH services. I won't mention any names of partners to drag them through the mud, but we had already spent almost 2 months integrating their technology, and at the last minute, someone in the C-suite saw our account on someone's desk and said, "Oh, that's a chemical marketplace. We don't want to move money for chemicals. Cancel that project." So then all of a sudden we lost 2 months and had to go to the next one. Then after that, then we were working with another ACH provider, and they said, "Okay, great, we'll do it, even though your chemicals, not like we're creating bombs or anything like that. They're like, but you can only do $50,000 until you kind of earn our trust a little bit more. And like, well, we have customers that are doing up to $1 million per transaction. We're a large scale B2B platform. That's what we want to be. And you're limiting us to a very small subset of this industry. And so that was kind of the precipice, and also what pushed us to doing the merger with the Fintech company that unlocked a lot of those challenges that we had with dealing with some of the vendors. But I would say those are two examples of frustrations we had with just the ACH money movement, where people don't either understand your market or your industry, or there's too much limitations, or they'll agree to it, and then all of a sudden, some new CFO will come in and they'll start moving the goalposts on you, and you're like, well, we already built our entire model around this, and now you're saying we have to change our per transaction limit. So I think also making sure you have a backup vendor is something really smart too. If you're really going to rely on that service, make sure you got a backup to go to if someone really just ends up, pulling the rug underneath you.
Can I, Nick, build on that really quickly? I remember specifically early days having sort of this moment of, I didn't know that. And I'm talking about money transmission law, right? Which is when you're really getting your hands around things, really have just a couple of options of how you're going to be a marketplace, right? Are you going to be a marketplace that's going to let me back up for those who don't know, is that you can't accept money from a buyer and give it to a seller unless you've taken title of it as it crosses the platform, right? Mm-hmm. Or you are some way, either yourself or somehow associated with an entity that has the right or money transmitter's license, right? So you can't just sort of like put your 10 out and say, hey, I'm going to start taking payments. So it's not that simple. So I remember one of the big early things was, oh, we can't just do that. So solving for how are we going to sort of curate this transaction, but not touch it, right? Mm-hmm. How do we just sort of make sure everything goes well, but we can't touch the money? Like, it can't flow through our bank account, and then there are other solutions out there that we tried early, and we're like, well, they're holding on to money forever. And if we're using financing to get this stuff paid for, we don't want to pay for an extra 5 to 10 days of financing because some third party feels like holding on to it for a while. So it's sort of trying to figure these things out and find these balances.
Very good point.
Right. And you both have kind of talked about the need to find partners here. How do you approach the kind of decision? And I'll start with you, Scott, to kind of build it yourself versus partner, and sort of where do you decide to go with outside help?
Fortunately, I have someone much smarter than I, Rena Tobble, that's on our team that does the vetting on that and comes from a banking background. But yeah, she's vetted with looking at every opportunity and, what can we do internally and what can we do, what do we need to do through a vendor? And then there's the third bucket of what will we do with a vendor for the next year. And then we can eventually transition where we'll have enough funds in our next round or raise or whatever to be able to start doing that internally. So every single time we make a new decision on in-cart financing, in-cart factoring, ACH movement, wire escrow capabilities, we go through that. She's got a very well written out process of vetting that opportunity and decision-making process.
Question for you, Shep. Go ahead.
I would say this is pretty straightforward. Meaning, so I come out of the steel industry and was, look, just because we want to take things like do it in a digital way doesn't mean there's a huge appetite for changing the way things are done, right? You just sort of do like a digital analog, if you will. So I knew exactly the framework that it had to be. And when you go to a BNPL, I mean, within moments, if you know exactly what you want. Within moments, someone's like, yeah, we don't do that. Or they say, oh, I mean, sure, we'll give it a shot. And it's usually the people who are game, they're smart, they understand the opportunity, and they're just like, yeah, well, and you start working together. And there's a bit of a risk to doing that. But the reality is, if we want to have good BNPL solutions for B2B applications, you kind of really have to work together to make these solutions fantastic. So and the reason they're not just automatically happening is because it's going to take somebody from the industry to make these solutions real. I mean, B2C solutions are obvious because we all buy tennis shoes. We all go buy oranges. Like, you don't have to have a specific job in a specific corner of the world to understand that stuff, right? But when you talk about industry and very specific supply chains, you have to have lived in there and seen the ins and outs of that to say, okay, we have this experience. Who's the right fintech or BNPL that wants to be part of this? So anyway, I don't even know if I answered the question, but that was important information.
Yeah. One quick thing I was going to add to that too is that I think this is all going through steps and phases. And I think people are trying to see, how can I get to that next step where I can just at least offer B2B payments and in-cart financing and factoring, which is going to be great, especially if you're one of the first people building a new marketplace or offering to a new industry. If you fast forward in 5 to 10 years, it's going to become an arms race of who actually owns as much of that technology internally. It's the reason why we gave up, honestly, almost half of our company to merge with a fintech company, because we believe that's going to be so critical in the future. And so if you are completely reliant as a marketplace on 10 or 12 different vendors who are all taking money out of your core transaction, you're going to be in a very weak position. But if you start investing in that early, investing in that technology, and understand that's got to be part of your roadmap, and also part of when you're raising money, that the X amount of this is going to go towards continuing to build out our fintech technologies, I think those are the people that are going to win in 5 to 10 years.
And Scott, I'll start with you. What has this done? You said this was a big priority. You merged with the fintech company. What's the impact been from a unit economics perspective? Has this impacted things like CAC, LTV, churn, user retention? What's the impact been for you guys?
Yeah, I mean, this has kind of been, like you mentioned, part of our DNA since day one. So it wasn't like we brought this in halfway through and then all of a sudden we can kind of track how it's changed it. It's just like been how we've been since day one. But I think the biggest thing, it kind of goes back to what I was saying at the very beginning. Both Shep and I have an extremely large task in front of us, where we're trying to take industries that, at no fault of their own, have been operating the same way offline in a linear business model for the last 100+ years. And we have this responsibility to provide enough value that gets them to come on and start doing transactions in a different way online. So I think the thing that we track is how many new members are we bringing into the system that have done at least X amount of transactions on the system. And that's what success, we're starting to see a change in patterns of how they operate. And so that's where, like, wow, we took someone that has never done a transaction online, and now all of a sudden they've done 5 transactions on our system. Like, it sounds like a small amount, but that's really a massive victory for us in the early stages. So.
Shep, go ahead.
I have nearly nothing to add to that. I mean, it's such a, all I would say is that having your own sort of, they merged and we built out, is sort of a prereq for where we're going. Like, it just has to be in the DNA of the market or the platform. And as I said at the beginning of this, this is a market network, which is just like a string of solutions, and they are all critical, And so this is just, we're trying to raise all of those sort of up at the same time incrementally. But I would say, in a general sense, the people who evaluate these platforms, I think that they like them, and I know that they like them, but they really want just a very seamless experience, and they just want it to be end to end. And that's really just the end to end comprehensive nature of it, any more than any one piece, is what really makes it happen.
Got it. I'm going to shift to some audience questions here. First question. they've got is what does the implementation timeline look like? If I'm a distributor or marketplace and I'm looking to put this feature in place, what should I expect getting into that?
Long. I mean, it all depends what your aspirations are. It all depends what your strategy is going to be. And that's kind of what I was discussing before. Do you want to control the cart? Do you want to be the one that's managing that entire checkout process from end to end? Are you going to go and then license with someone to bring in that technology and it's already built for you? That's what we built our cart out. Our product is actually called Trade Cart, and we'll be licensing that API in the future to other B2B marketplaces or companies that are selling B2B transactions online. But it's really going to come down to like, how much of this do you want to build yourself? How much of this do you want to like piece together? Like if you're building a model airplane, are you planning to go buy the wing and then the little motor and the little wheels and the glue and whatever? Or are you going to go buy the plane? How much work are you willing to invest into this and time? So I know that's a horrible answer because it's not answering the question, but it just depends what path you pick, about how labor intensive it's going to be.
I would agree with that.
It probably took about a year. Sorry. It probably took about a year. And it's still in process as we try to move internationally and bring in some different payment types.
So if I were a distributor, and wanted to just simply have, integrate some sort of checkout capability. I mean, that's something you could do very quickly. And I mean, in, a matter of weeks or something like that. But I would caution you that may be more disruptive to integrate this one element because now you're adding basically another system to your litany of systems you're already using, right? So you're jumping in now to a new piece of software. And I think what Bluepallet and Bryzos really, what the value is that's already done. And we have all the different software services leading up to a checkout and all of them after the checkout, right? So you can kind of do this one little piece of integration, but I think that you have people like myself and Scott that are like dedicating their lives to making sure that this thing goes as well as possible. But to answer your question directly, I mean, these APIs are so slick. You could have it done in a couple of weeks if that's all you wanted to do.
Mm-hmm.
Right. Another audience question. This is a good one. In my experience, enterprise credit facilities require lengthy forms or at least a personal guarantee for new businesses to de-risk. Have you seen that the fintechs here can speed up the approval process, and is it reliable? How would you rate its risk-taking level versus the old practices?
Go for it.
Well, I was going to say the old practices really run the gamut of discipline. So you have the old practice is somewhat related to the size of the purchase order, I would say, versus the business that's asking for the credit. I mean, you go and you say, hey, can we get these guys a credit line? Like, well, how big's the PO? And so that was sort of how that worked to a degree. It's not quite that hazardous, but to answer the question, BNPLs are getting better like every single day at underwriting and getting a credit line back. So as far as the riskiness of that, well, that's that's their decision. I don't really have a lot of insight into how good or bad the decision making is. But I would say as far as credit lines, when I first started working on this, an average credit line would have been like $5,000 like 6 years ago or something like that. And now, we have buyers on our platform that are in the millions. So it's I would say it's come a long way in a short period of time.
Yeah. I'd split it kind of into two buckets, I guess, for us at Bluepallet right now. So we've got the marketplace component where we're choosing if we're going to give someone credit that comes onto the platform. And then we also have the network component where these individual trading partners, the buy and sellers, are choosing if they're going to give credit to each other. And so each one provides challenges and each one also provides opportunities for us to add value to that. So that was one of the biggest challenges we had just recently, where we had our sales team come in. We're like, hey, we've got all these buyers now signing up for the marketplace, but like, and one company that we don't really know that well, like all of a sudden just put $100,000 of orders through. Like, at what point do we need to cut these guys off, or how do we make that decision? So, at that point, then we're picking, the three things from whatever sources we're bringing in from data from their trade pass. And also if they're bringing information on what their credit risk score is and what their suggested credit level should be, and then adjust from there. Because I'm being more candid, where I'm like, we're not much further along than that. But what the vision is on our trade pass technology, and I think this is something that everyone should consider as well, is if you can start identifying these participants, tracking their activity, and allowing trading partners to monitor their other trading partners, not just in a snapshot of like, okay, I'm deciding if I want to do business with Shep. I can see that, he's got this credit score, and he's got this much insurance, and that's great. I've decided to do business with them, but providing an information and data flow where he can continuously see if I can see if Shep's continuing to be a good trading partner, and then I can adjust up and down. I think that's a critical component that's an opportunity that's available now, instead of like the traditional onboarding and saying, which also takes 5 to 7 days to bring a new customer on and check their credit, and then tell everybody in the sales team, great, these guys get a 100K credit line, but you have no idea 3 months down the line, if something happens during COVID, that company starts having financial problems, like you have no visibility into that. In the way that it's set up now, you're just going to be the one that catches the falling sword. The opportunity that's available now is that with all these data points coming in through these technologies, and also you should be, as a platform and a technology, giving that visibility back to the trading partners so they can make better credit decisions. So
definitely. In terms of the types of net credit terms that are being extended here, is net 60 or net 90 actually happening, or are we really just talking net 30 in terms of what's out there in terms of options?
Shep, you want to?
Yeah, it's totally up to you, is what I would say. It's how you organize your platform. Meaning, do you want to integrate costs into your platform, the cost of using the platform, or do you want to sort of split it between buyers? It's just what's the tolerance of the buyer and seller to pay for something like this, right? So if there's more slack or more GP that lives in a certain supply chain, or let's take an example of like custom products, for instance, right? That somebody's had quoted a drawing, and there's like a 50% GP in that. There's probably going to be more slack in that for someone to buy more payment terms. The tighter, the more you compress GP, the shorter those terms are going to be. And that's a problem inherent with buy now, pay later that's hard to solve for, which is historically credit has been free. So how do it's just been free. It's just been part of the deal. So saying you have free payment terms, they're like, yeah, no kidding. I've had them for 100 years. So that's part of what's baked into this also. But to answer the question, I think it's what is the tolerance as dictated by the gross profit within that certain product type. What is the tolerance for paying for terms? I think that's the answer in my view. Yeah.
Yeah. And then I think my answer would come in those two buckets again, where we have the marketplace that we're controlling, and then the network transactions that are happening between the direct buyers and seller. For us, we kind of built it off of what the industry standard is. And for the chemical industry, the industry standard's net 30. And then we allow the buyers and sellers to build off of that. So, we're slowly seeing net 60, net 90. And then, if the seller needs to get the factoring and get to net 10, they can do that as well. That's on the marketplace component side. Now on the direct network connections and those transactions, the seller is dictating on our platform for every single buying partner that they have. So every single one has a different set of terms, and then they can start building off of that. But then kind of also building off what Shep said, sometimes credit's free in some of these standpoints, but there's also an opportunity for you to provide value back to a seller on your platform and say, I'm going to build into my platform where you can even start setting a different pricing depending on terms. So say that you're willing to give a discount if someone's willing to accept and pay a net 10 or a net 15. So, you may not be in the middle of that. You may not be getting revenue off that, but you are adding value to the buyer and seller in that transaction flow or the core transaction there.
Great. Last question, and I'll start with you, Shep, and then we'll go to Scott. We've been talking a lot for today about kind of how you got to where we are today and what does today look like. But how do you see fintech kind of evolving, and particularly in the B2B distribution, B2B marketplace space? What does the future look like from your perspective? You're muted there.
I can't say for certain what it looks like, but I can tell you what I see as sort of still some sticking points in current solutions, right? So I would say that the future would probably include solving these. So I don't think one of the big things that's still not being managed as well as it could be is reconciliation, right? That's still one of these processes that's very manual on a lot of platforms. And it's sort of been solved the way people solve KYC, which is they're delegating it. They just it's like a hot potato. They keep passing it downstream and saying, okay, well, we don't have a way to do this necessarily 100% audit. We can catch maybe like 90% of it and get them lined up. But ultimately, there's going to be 10% that's going to have to be manually dealt with. So I think that there's going to be, that makes sense because, when you think BNPL, the first thing you're trying to figure out is, underwriting and liquidity, right? So it makes sense that the end of the process is the last thing to really be solved for in a meaningful way. And then beyond that, I just think that there's going to have to be a solution around the reason open terms or trade finance works historically is because you have so many companies pitching in, right? Now it's on a platform, you can easily say, okay, buyer and seller, you guys just take your own risks between yourselves. That's one thing. But if we're talking exclusively in the context of buy now, pay later, supply chains gobble up an enormous amount of money, like incalculable amounts of money. And how can we get buy now, pay later, like these sources of liquidity to such a magnitude, huge amount of capital to really be a long-term solution for all these dollars that move through supply chain? So I think that's sort of the first kind of log jam is going to be how much capital is really available for buy now, pay later solutions.
Great, thank you. And Scott, as you peer into your crystal ball, what are you seeing in the future for B2B payments and trade credit? Near-term future, I think it's going to be table stakes for any marketplace to have B2B payments. And I think that's going to be a required component for someone to actually be defined a marketplace. Secondary, peering into the future, that I can't understate the value of this for the future of B2B commerce. We saw this during during COVID. We had switched our platform over from any type of raw material and chemical to just COVID-related raw materials and COVID-related products. As we started doing that and working with some state and government bodies, we started and healthcare companies, we started getting in the middle of these large international transactions between U.S. healthcare providers and Chinese suppliers. And it was out of our realm and our technology to be able to facilitate those orders on a logistics standpoint, but also on a money movement standpoint. And also being able to secure and verify who that person on the other side of the transaction was in China. So we sat on the sideline and watched. We're not trying to make any money off this. We just want to do, good for the country or whatever to help out with the COVID related products or efforts. And so we would watch these transactions go down. And you would sit there and you would watch this U.S. healthcare provider all of a sudden negotiating with a company in China, and they would say, "All right, I have $10 million in nitrile gloves. You need to wire me $5 million right now to my suggested third party escrow provider, and then and then another $5 million once it hits the port of Long Beach."
and you've got 5 minutes to decide because I've got 10 people on hold right now that's going to take this product. And then all of a sudden, this US healthcare provider has to play this game of Russian roulette and decide, do I trust this partner in China that I've never done business with and send them $5 million to their own escrow party just to hope that I'm going to get something that's going to show up in that shipping container? And so it was amazing, mind-boggling, scary to see how poor supply chain operates when things go bad and it's not your traditional channels. And so we saw that as an opportunity. We said, we're not able to solve this right now, but in the future, we are going to build a product that is going to make sure that when that US healthcare provider gets in contact or gets connected with that Chinese supplier, they're going to know instantaneously who that Chinese supplier is. They're going to know their transaction history. They're going to know how many of their orders are on time. They're going to know there's going to be an escrow capability to move money that they're going to be able to trust. There's going to be insurance on that transaction that's going to be part of that. They're going to be able to choose from escrow. They're going to be able to choose from cryptocurrency. They're going to be able to move money from internationally from the US into China and back and forth and not have to think another second about it and be able to do it securely and safely. That's what we built, and we'll be releasing internationally in the next 3 months on our platform. And that is what's going to move everything with B2B forward. There's not that right now. And so a lot of these companies are able either to match make, which I don't think is a marketplace, or they're able to start moving money domestically. But as we're starting to see all these things happen within the world with COVID, with pandemics, with hurricanes, with Texas freezing over, Panama Canal, all these things mess up everything with Chef's industry, with my industry, with all these other massive industries. And until we have B2B payments that can work seamlessly and allow transactions to happen, not just domestically seamlessly, but internationally seamlessly, we're going to remain victims of that. But if and when we solve that and we encourage more and more B2B marketplaces to come out and push themselves to really build these solutions within their platform, it is going to have the largest impact, I believe, on B2B commerce and then also on humanity. And I'm not trying to make it sound too Pollyannish and big, but I honest to God believe it. So that's what I believe the future is going to be on that.
Thank you very much, Scott and Shep. That'll be a wrap for us here. You've gotten a lot of insight from both of them into kind of their journey, both for Bryzos and Bluepallet, who have been real leaders in embracing this B2B payments innovation and bringing that online for their respective marketplaces. And you got a window into the future and what we think's happening. One last question we had from the audience was about who are some of the different Fintech providers. We at Applico recently put out a report, which includes some of the top providers in there. We'll share that along with the recording for everybody who signed up. So you'll be able to check that out in your email. Scott, Shep, thank you again for joining. Your insight here has been invaluable.
Thank you very much. Really appreciate it.
Thank you.
Modern monopolies.
Appreciate the plug. That's a wrap for us here today. Thanks everybody for joining.